Somewhere in Germany, in 2008, a bank employee sat down to process a routine wire transfer. The amount was supposed to be 62 euros, roughly the cost of a nice dinner. Instead, they fell asleep at the keyboard, and when their hand landed on the number pad, it didn't type 62. It typed 222 million. 222 million euros, nearly $293 million, sent out in a single transaction because someone's finger rested on a key for too long during a nap that lasted seconds. This isn't an urban legend. It's a real recorded incident, and it opens up a genuinely fascinating question most people never think about. What actually happens when a mistake that enormous occurs inside one of the most heavily monitored systems in the world? By the end of this video, you'll understand exactly how a mistake like that gets caught, why the safeguards work the way they did, and what this bizarre story actually reveals about how modern banking really functions. Let's start with the mechanics of what actually went wrong. In large-scale banking, wire transfers are often processed through systems where an employee manually enters values into a form, and in a moment of literal, physical sleep, sustained pressure on a single key can register as that digit repeating far more times than intended. That's essentially what happened here. A number that should have had 2 digits somehow ballooned into a 9-digit transfer, and the system accepted it as a valid instruction, because on a technical level, nothing about the request was invalid. It was correctly formatted. It just wasn't what the employee actually meant to send. This is worth sitting with for a second because it reveals something important. Modern banking systems are extraordinarily good at verifying that a transaction is properly structured. They're not automatically good at verifying that a transaction reflects what a human actually intended. Here's the part that surprises people the most. The transfer actually went through. It wasn't blocked instantly. The money left the sending account and was, for a period of time, genuinely in transit toward its destination. This is one of the more unsettling realities of large financial systems. Speed and accuracy don't always move in perfect lockstep. Wire transfer systems are built to move enormous sums quickly and reliably between institutions, and reliability, in this context, mostly means the message gets delivered exactly as instructed, not the message reflects what the sender truly wanted. In other words, the system did exactly its job. The problem wasn't a system failure. It was a human error that the system had no built-in way of independently recognizing, because from a technical standpoint, there was nothing that looked wrong about the instruction itself. So how does something like this actually get corrected if the system itself doesn't automatically flag it? This is where the less glamorous, more human side of banking comes in: reconciliation. Banks routinely compare the total amount of money leaving an account against internal records of what was supposed to leave that account. When actual outgoing transfers don't line up with expected activity, that discrepancy eventually surfaces during review, even if it takes some time. In this case, once the mismatch was identified, the bank moved to reverse the transaction. Because the story is now widely cited as an example of exactly this kind of costly clerical mistake, we know that the situation was ultimately resolved rather than resulting in a permanent, catastrophic loss. But here's the important nuance. Eventually corrected is very different from instantly corrected. There's a real window of time, sometimes hours, sometimes longer, where an enormous, unintended transfer is technically sitting somewhere in the financial system, fully valid, fully processed, and not yet noticed as a mistake. It's easy to treat this as a quirky, almost comedic anecdote: a tired employee, an oversized nap-induced typo, an absurd number of zeros. But underneath the humor is a genuinely important lesson about how financial systems actually work, one that applies just as much to your own bank account as it does to a European bank moving hundreds of millions of euros. The systems that move money, whether it's a massive interbank wire transfer or a simple bill payment from your own account, are fundamentally designed to execute instructions accurately, not to second-guess whether those instructions make sense. Speed and convenience have been prioritized for decades over built-in skepticism about intent. That trade-off usually works out fine, because most instructions genuinely are what the sender meant. But it means that when something does go wrong, the system itself often isn't the safety net. People catching the discrepancy after the fact are the safety net. This connects to something genuinely useful for anyone managing their own money, not just billion-dollar institutions. Most people assume that if they make a transfer mistake, sending money to the wrong account, mistyping an amount, authorizing something they didn't mean to, the system will somehow catch it before real damage happens. That assumption is often wrong. Just like the bank in this story, most payment systems execute instructions as given, and correcting a mistake usually depends on someone noticing it after the fact and taking action, not on the system automatically preventing it. That's exactly why practices like double-checking transfer amounts before confirming, reviewing account statements regularly rather than assuming everything's fine, and reporting discrepancies immediately the moment you notice them aren't just cautious habits. They're doing, on a personal scale, the exact same job that reconciliation teams do at massive financial institutions. You are, in a very real sense, your own safety net. Here's the strange irony sitting underneath this whole story. The same systems trusted to move hundreds of millions of dollars with total accuracy have no built-in way of knowing whether a human actually meant to send that amount. Precision and intention are two completely different things, and modern banking is extremely good at the first one while depending entirely on people for the second. The people who avoid becoming an accidental footnote in a story like this aren't the ones who trust the system blindly. They're the ones who understand that behind every reliable system, there's still a human check somewhere in the loop, and sometimes that human check is you.